Welcome to The Explainer. Today, we're diving into the insider's guide for any sophisticated borrower trying to navigate the very high-stakes world of the 2026 Credit Committee. We're going to show you exactly how to turn all that uncertainty into a funded deal.
All right, let's just jump right in because, look, in 2026, the Credit Committee, it's not some simple checkpoint anymore. No. It's the final gatekeeper. It is the single biggest hurdle you're going to face getting your deal funded. You have to understand this isn't just a step in the process anymore. It pretty much is the entire process.
So here's how we're going to break it all down for you. First, we'll talk about this new execution risk. Then we'll walk through the 5 stages of approval. After that, we get to the good stuff, what committees really want. We'll also cover some common and pretty dangerous misconceptions. And we'll wrap it all up with a strategic playbook you can actually use. Okay, so first up, the new execution risk. I mean, what's fundamentally changed here? Let's dig into this new landscape, because I'm telling you, for any major financing deal, the old rules, they just don't apply anymore.
Now, you got to realize this level of intense scrutiny isn't for your average loan. We're talking about high-value borrowers here. Think C-suite execs, high-net-worth individuals, and big institutional investors. See, all the smaller, standardized loans, that's all handled by algorithms now. But these complex, high-stakes deals, well, that's where human judgment and, let's be honest, human risk aversion really comes into play. And that's the whole point. The credit committee process isn't just a simple yes or no checkbox anymore. Not in this market. It's a full-blown, complex negotiation. We're talking about structure, timing, and risk. And here's the kicker. The bank's internal reality is now just as important, if not more important, than your proposal. Okay, let's move on to the process itself. Let's see how this thing actually builds. Because, while the stages might look familiar on the surface, the friction points, the sheer level of rigor, it's all intensified dramatically. And this is where you can really see the changes. In stage 1, that initial review, it's all about real-time data feeds now. Then in stage 2, the credit memo isn't just a summary. It's packed with heavy-duty stress tests. During deliberation in stage 3, they're using data visualization to stress your deal live in the room. And the decision? In stage 4, it's rarely a simple yes. You should absolutely expect conditions. And finally, stage 5, it now includes these new monitoring triggers that can literally pull your deal right back to the committee even after it's been approved if the market shifts. All right, this brings us to the absolute core of our explainer today, getting inside the mind of the decision makers. What do these committees really want? Because let's face it, if you don't know what they're looking for, there's no way you can give it to them. The entire mental model has just flipped. It's not about, is this a good deal anymore? That's old thinking. The real question they're asking now is, does this deal fit our current portfolio exposure? See the difference? They aren't just underwriting your proposal, they're underwriting it against their own balance sheet and this crazy volatile market. And durability, that's the new magic word. Your old static cash flow projections, you can pretty much forget them. They're practically ignored. What committees demand now are dynamic models that prove, without a doubt, that your deal can survive a really prolonged market storm. I mean, they want to see exactly how your cash flow holds up if rates suddenly jump by 300 basis points. That's a huge 3% increase. Or what happens if your revenue just drops by 20% overnight? Trust me, they are not focused on the upside here. They are absolutely obsessed with the downside. And this is a critical point that so many borrowers miss. Your deal does not exist in a vacuum. It's being judged based on how it impacts the bank's overall risk balance. So what does that mean? It means if they're already heavy on, say, tech sector debt, your perfect tech deal, well, it might be dead on arrival. This case study here with the high net worth individual, it's a perfect example. The deal got stalled, right? But not because of credit quality. The equities were top tier. It was held up purely because of the bank's own portfolio concentration. And the solution wasn't offering better terms. It was about bringing in different collateral to balance things out. So getting that committee mindset right helps us avoid the common traps. And believe me, these are traps that even seasoned CFOs and the most sophisticated investors fall into all the time. So here's the question. Is a credit-approved email a guarantee of funding? And I'm telling you, this is maybe the single most dangerous misconception in this entire process. You get that email, you think it's time to pop the champagne, but you would be very, very wrong. The answer is a hard no. In 2026, credit approved is almost always conditional. The crucial takeaway here is to treat that approval as a milestone, not the finish line. The deal is not truly done until that final credit sanction is issued, and the conditions you need to meet to get there, they are absolutely non-negotiable.
Okay, what about this one? Once you're approved, is the deal safe from market events? It's another huge misunderstanding. This idea that an approval is locked in, like it's some kind of shield against whatever is happening in the world. Well, that is just not true anymore. No, it's not safe. Committees now have the mandate to re-review, amend, or even pull an approval right up until the moment of funding if the market's risk profile changes significantly. And this is a total game changer. It means a major global event on a Tuesday can completely torpedo a deal that was fully approved on Monday. The risk does not end until the money is physically in your account. Okay, so now that we're armed with all this knowledge about the risks and the committee's mindset, how do you actually prepare for this? How do you engineer your deal to ensure it doesn't just get approved, but actually gets funded? Let's get into the playbook.
This right here, this is your new strategic playbook. First, you have to anticipate their objections early on. Address the weak points of your deal right in the initial memo. Don't hide from them. Second, structure for that downside protection we talked about. Maybe offer some tighter covenants or extra collateral. Third, build in timing buffers. Just assume the whole process is going to take 30% longer than anyone tells you. And this is a big one. Understand their internal capital context. You have to ask about the bank's current appetite for your sector. And hey, don't be afraid to explore alternative routes, like private credit funds, if you need speed and flexibility.
And please, it is so critical to understand that this is not some temporary, cyclical trend that's going to reverse next quarter. This tightening, it's structural. It's being driven by stricter capital regulations, way more internal scrutiny, and just plain old market volatility. So adapting your strategy isn't just a good idea, it's absolutely essential for survival. So here's the key takeaway for 2026. Approval is not a binary yes. Think of it more like a dynamic state, something that has to be actively managed. In this environment, it's not just about getting to that initial yes, it's about managing the deal, protecting that approval, and steering the whole thing all the way through to completion. And that's really what it all comes down to, right? In this environment, certainty of execution is the most valuable currency. In a volatile market, the most valuable thing you can secure, it isn't the best price or the lowest rate. It's certainty. Thank you for joining this explainer. The final thought I want to leave you with is this. Now that you know what these gatekeepers are really looking for, how are you going to restructure your next proposal to make sure it doesn't just get approved, but it actually finally gets funded?